Welcome back, and you're watching Commodity Champions. We are going to now talk about the international commodity space, which actually has been quite volatile. Crude oil prices are down more than 20% in the month of November, weakest November actually in last 10 years. As far as the reasons are concerned, well, it's the near-term oversupply that's weighing on prices, and adding to that is slowdown in oil demand growth. OPEC and Russia are expected to agree to supply cuts next week, but the U.S. crude stocks have risen for a 10th straight week. And as far as the forecast is concerned, well, the latest reports show that Citi is expecting the Brent crude prices to be at $57 barrel as an average price for the next year. JP Morgan, S&P Global Platts are expecting it between 70 to 75, while ABN AMRO expects crude to be at $90 per barrel. That, of course, is for the Brent prices there. But let's get in an expert, and we have Nick Parsons, Head of Research and Strategy at ThomasLloyd, joining us from London live. Nick, hi, thank you so much. I first of all want to really talk about the crude price forecast that many banks are coming out with, 57 as the lowest and 90 as the highest. What is your own sense on where are we headed in 2019?
Well, I'd be astonished if it were 90. I think that's an extremely optimistic assessment of where we're likely to be. I think when we look at crude, the real puzzle for 2018 is not why WTI is at $51 today, which is down, what, 13–14% from where we were in early January. The puzzle isn't why we're at 51, it's why on earth we were at 75. And if we go back to, what, that first week of October, 75.90 for WTI, because already at that time we were seeing signs of tension in world trade. We were seeing a slowdown across the G10 and more broadly into G20. The dollar was still strong. So all those things which traditionally have tended to weigh down on oil prices were all present, even as it was going up. And so for me, the surprise isn't so much that we're in the low 50s today, but it's that we ever got above 70. And so putting that together, if I was surprised that we were above 70, I'd be frankly astonished if we get to 90 during 2019, absent, of course, some unforgivable and quite catastrophic supply shock. So I think that looks way too optimistic.
So, Nick, you're saying that current fundamentals are in line with the kind of reaction we've seen on prices?
Well, I think so. I mean, if we started the year at what seemed to be a genuine balance between supply and demand, with West Texas either side of $60. Now, here we are with some slowdown in world growth, slowdown in trade, some concerns and uncertainties about the economic environment for 19, and WTI is at 51, 52. Well, actually, given the balance of risks that we're facing, a 14% decline on a year-over-year basis, okay, we're 11 months of the year to date, but a 14% decline doesn't seem to be particularly outrageous. And if we were at or around current levels, but I think probably with an upside bias because of potential US dollar weakness, that's the most likely trajectory that we're going to see into next year.
What's your sense on the crude prices trading, or rather price range for the next year now? What are you making of the prices right now?
Well, let's again put this into context by looking at the range we've already had for 2018. We've had a low just below 50 and a high just over 75. So we've already had a $25 range over what was overall a fairly low midpoint. And so I think any forecast for 2019 has got to allow for the fact that we could see a range as wide as $15 to $20 from high to low. So picking a precise point figure within that requires as much luck as it does skill. But I would have thought an average price around $60 on a quarterly basis through 2019 would be a good starting point for thinking about analysis here.
Well, that, of course, is about the crude oil prices. But, Nick, we have seen so much volatility come in for the industrial metal space as well. And while, of course, many of them are double-digit down for 2018, we really seem to be closing the year negative for most of them, barring some strength, a bit of a strength in copper that we've seen come in for the month of November. How have you seen the industrial, rather the global, trade tensions, and do you see that spilling over into the new year as well?
Well, I think what we've expected, and it's a view that we've expressed several times on your show before, is that we would see precious metals outperforming base metals because of the potential slowdown in world growth in 2019, and as that was playing out perhaps even a little earlier than had been forecast. So the weakness in global demand, the softness of the global economy, and the downward revisions to output growth have certainly weighed down on base metals. Precious metals, by contrast, have begun to have been outperforming throughout this fourth quarter. Gold looks like it's going to have its first time this year back-to-back monthly increases. So gold seems to have turned. Precious metals seem to be on the way up. And I think if we look at what's happening to the US dollar more broadly, and bearing in mind that very strong inverse relationship between the dollar and metals prices, then I think we might begin to hope for some bottoming out here of industrial metals. We've already seen it, as you rightly mentioned, in copper. We've seen it in a few others as well. Even though November was generally a month to forget for commodity investors, we have seen precious metals outperforming. We have seen gold picking up. And for those of you, your viewers, who like to look at the technical situation on what the charts might be telling us, something that's happened this last week for the first time in over a year is that the 50-day moving average has closed up through the 100-day moving average, which is often quite an important technical signal, and does suggest that the momentum players could be coming in to look at the gold market, especially if we have indeed seen the top in the US dollar, and a slightly weaker dollar going forwards will be helping those trades.
So, Nick, if you had to pick a metal for, putting it in your allotting monies into for 2019 now, which one would that be? Is it going to be from the industrial metals, or is it going to be from precious metals? And what kind of gains are you expecting there?
Well, I've already done it in terms of my own asset allocation, and that's to increase exposure to gold. And that's been through gold ETFs. And if we look at the price of gold, which today, what are we, 1,222, so we're 1,222 at the moment. I think we could see 1,250 or 1,260. And if we were to see both a sharp fall in the dollar and further volatility in global asset markets, then I think the perceived safety of gold in troubled times will be something that will be very attractive to investors. So I'd pick gold out of them. Of course, there could always be one random metal that happens to do spectacularly well because of an unforeseen supply shock. But of course, by definition, that would be unforeseeable. But gold would be my favorite pick.
All right, we hear that, Nick, and thank you so much for coming by and giving us helping us make strategies really for 2019 for all of those commodities. So, talking about the crude oil prices, Nick expects that to average at $60 per barrel. And gold clearly is a better pick really going forward in case of 2019. That, of course, is about the global commodities, and with that, that's all the time that we have on this edition of Commodity Champions. Thank you for watching.